Hello and welcome. You're watching the Money Show and the special edition of Money Show. I should be saying that because we are going to be talking about Outlook 2025 when it comes to equity and debt. So let's talk about fixed income, and I've got one of the best voices as far as fixed income is concerned. I have Mahendra Jajoo from Mirae Asset AMC. Thank you so much for joining us today. And yes, what is the outlook that you have given out for fixed income? You know, we are looking at rate cuts from the US. We are looking at good growth in India. The last year, or if I can just call this particular year because it's about to end in a few days, debt has been one of the focus for investors, especially talking about retail investors. You know, people have made money, people have parked money more than fixed deposit. They have opted for fixed income instruments as far as mutual fund is concerned. But if I want to analyze the global situation right now, where do you think the fixed income tragedy will lie in 2025?
So from our perspective, it's very clear that 2025 will be a good year for the fixed income investors again. Okay. In 24, if we look at Indian context, I think it's after a gap of long time that the bond funds have given a double-digit return. Right. And we are quite hopeful that in the year 2025 they'll repeat that performance. Okay. And that's because the tough time for the fixed income in terms of the rate hike cycle is behind us. In 2023, the rate hike cycle ended. In 24, in the second half, the rate cut cycle has commenced. And we are of the view that the rate cut cycle will continue in 2025. So if you look at the recent FOMC meeting and you look at their dot plot projections, they are looking at a 3% kind of a terminal rate. They are right now at 4.25, 4.5. So there's still some distance to go. And now there is a lot of, I think, concern in the market because the 10-year US yield has gone up post the FOMC. But I think those are the intermediate periods when those volatilities will be there. We have seen last year also that the sentiments kept swinging from positive to negative. We saw 5-year yield on 10-year US last year. So I think these are the periods where you get opportunity to add more, because what we should focus is the end of the cycle and not the intermediate disruptions, because they have cut rates by 100 basis points in very quick time in the last 2.5 months. Yeah. So it is natural that they would now want to wait and see how the situation evolves. And especially with Trump victory, there has been some sort of clouding of the vision, because we don't know how the things will evolve. And same is true for the central banks. They would wait and want to see how things pan out. Same thing with India. If you look at the one common statement in every interaction which our previous governor had with the press or with the media or with us, they said, because our growth is so strong, it gives us the space to align our long-term target of 4% of inflation on a durable basis. Now we know that in the last quarter the growth has kind of slowed down and the GDP number was very disappointing at 5.4%, much against the expectations. And then the RBI has already revised its growth projections significantly down for FY25, and then we don't know how things will go in FY26. Even though everyone is now saying that, okay, that was a one-quarter blip, I think it is fairly clear that now for the authorities, the economy has become a treadmill. So just to maintain the current rate of growth, they have to run faster. So I think RBI will have to have a divided attention and put more focus on growth just to maintain the growth. The second part is that inflation today, core inflation is below 4% already. The higher food, headline inflation is largely driven because of the volatile food prices. So just to give an example, if you look at the drop in inflation from 6.5% to 5.5% between say November and December, the largest contributor is the change in the tomato prices, right? And then in the morning I was reading the press that the onion prices have fallen by 70% in the last 1 month. So therefore I think when the growth begins to look shaky, I think the RBI will have to then possibly say that, look, we can look through this highly volatile price and look at the core of the inflation. Globally, I think with Trump putting a lot of effort in stopping the war, the geopolitical situation is going to improve. That should also hopefully be positive for commodity prices. So from whichever way you look at it, I think 25 looks to be a reasonably positive year, and we are very constructive for 25 for fixed income.
So what is the band of bond yields that we're talking about internationally and for India?
So in US, look, in spite of the rate cut, the bond yields are higher. So I think if we look at the last 3 years particularly, the gap between the US 10-year yield and Indian 10-year yield, which used to be about 500 basis points, has narrowed to 250 basis points. That's because US is a country with deteriorating fundamentals, and we are a country with improving fundamentals. So it is only natural that their long-term yields will be driven by their local fundamental factors. Therefore, I am not so sure how much the US yields comes down by or not. But in India, again, it's very remarkable. 24 was a year of no rate cut, no action from the Reserve Bank,
Right.
but we have a 10% return on bonds,
Yeah,
bond funds.
true.
So I think the evolving positive macroeconomic fundamentals are, to my mind, the biggest guide. And therefore, and again, we are not so worried about how much the bond yields come down by. We believe that directionally the bond yields are coming down by. So just to give a simple equation, if you are in a long duration fund, even if the bond yields come down by 25 basis points, it's good enough to give you close to 10%. So we are looking at very marginal drop in the long-term bond yields, but that should be good, impact on the long-term bond funds. We are far more constructive on drop in the belly of the curve, as they say 3 to 5 year, because now the credit growth has collapsed. RBI's stance has turned neutral and possibly turns accommodative in due course. The RBI has already cut the CRR. Therefore, if the liquidity improves and the credit has collapsed and the deposit mobilization by the banks has improved, then the current situation where the 3-year corporate bond yield is higher than 5-year corporate bond yield and so on, the inverted corporate bond yield curve will, I think, get corrected. The corporate bond yield curve will also become positively sloped. That is a very good situation for the short to medium term funds like low duration category of debt mutual funds or short duration category of debt mutual funds.
So now we've spoken about the outlook, which according to you is quite positive, but I still want you to identify a few red flags, if there are any, that might just stall our growth going ahead, or if inflation is a concern, what could be the red flags or those scenarios where we could see that the fixed income part in your portfolio can suffer slightly?
So from my perspective, there are two major red flags. One is that there are a lot of emerging markets where the stress is building up. So again, if you look at the media today, there is a story that Brazilian economy is in distress. Brazilian economy is collapsed is kind of headline which I read. So there are stress points within the emerging markets, and if that flashpoint happens, then obviously it will have a negative impact on the Indian economy. The second is, I think, the political situation in India is also little bit uncertain compared to the previous time, because this time we have a coalition government. As of now, things look very, very solid. But then all said and done, it's a coalition government. So even though nothing may happen, the market sentiment
will always sentiment will be
so
paying,
that would be one factor. Then again in US, again you have a new setup, and then there is a lot of negativity about the impact because of the trade barriers and the higher tariffs, etc. So we don't know how some of these things will shape up. And a lot of optimism I have in my outlook is driven by the fact that the geopolitical situation will stabilize. I believe that once in due course over the next 3 months, 6 months, the Russia-Ukraine situation will become much calmer and so on. If that doesn't happen, we don't know. So these are, I think, the major red flags to me. For me now, the inflation is not really the red flag.
Okay,
because
that's
even,
interesting. Yeah,
I think that's
been tackled very well.
That even in the worst of the situation, our inflation has not moved materially beyond 6% in the last 5 years. And the major cause of the big headline inflation in the global environment was the Russia-Ukraine conflict, where the food and the energy component of the inflation had spiked up. That situation has got reversed. So for me now, the data is not so threatening for the next year, but the qualitative side is where the nuance lies and where the opportunity or the threat lies.
Okay, last question to you. Time to go long in fixed income now?
So Kavita ji, we have been discussing that for last many more months, and we have had a year 24 where the bond funds have given 10%. And I think what is working well, there is no need to fix it.
Okay.
So
All right.
remain invested, add more is my advice.
All right. So remain invested and add more as far as your debt part of the portfolio is concerned. Thank you so much for joining us.
So I should again just correct myself. Important. It's not my advice. It's my view because I'm a fund manager. I'm not an advisor. Thank you.
Thank you so much for being on the show. Thank you.